voted when they can't get elected. Good morning, everyone. It's Jerry at the Fledge, and welcome to, I almost said 99 problems, but a pitch ain't one. It's not that. Astera's workshop with us to talk about the power of credit. It is part of our financial literacy series that we do the last Saturday of every month from 10 to noon. And we will be online, as you obviously know, online. We have people here. Look for the schedule so that you can come out to the next one. We'll start publishing that early next week. And also I want to remind you all that we have a app that Astera has provided to us. I'll say that. And we have a cohort that is the Fledge, and it helps us put together a team that works kind of together towards our financial health. So check this app out. You don't have to be associated with the Fledge necessarily. You don't have to have an account with Astera. And it's a really good tool to monitor your financial health and give you suggestions to make you what do I want to say? Financially healthier. So today we've got, I want to make sure, Shelby Anderson?
Yes.
Shelby Anderson here with Astera, and she will be going through the power of credit. I will put the presentation on the screen and we will get started. If you are online, please put comments in if you have questions or comments, and we will get those out to the rest of the room. So welcome, Shelby. Welcome, everyone.
Thank you. Thank you guys for joining me for the power of credit. If you want to go to the next slide a little bit.
Oops, 1 second.
Okay.
Get this slide up.
So a little introduction on me. My name is Shelby Anderson, and I am the Financial Outreach Specialist at Astera Credit Union. I've worked at the credit union for about 5 years in a couple different roles. I am a certified credit union financial counselor, and with that, I am a coach in our Empower Me program, which is our financial wellness program, and I'll get into that a little bit more towards the end of the presentation. Fun fact, I am a dog and a cat parent. I have my dog Willoughby and my cat Dora that I am obsessed with, and I could probably have a whole PowerPoint presentation on, but that's not why we're here today. We're here to talk about why credit is important. So if we can go to the next slide. We're here to talk about what credit is and why it's important. How do you build or rebuild credit? We're going to bust some of those credit myths out there and then talk about healthy credit habits to practice. So next slide. All right, I'm going to start off by asking you guys a question. Anyone online or in person, what is credit? What do you think credit is?
I think credit is, I guess from a financial perspective, trust in you to let you borrow money, and the belief that you will pay it back. But it could be the negative side too, the belief that you won't pay it back. Yeah. So something like that.
Yeah, that's good. So on the next slide, we can see that at its core, credit is going to be an agreement between an individual and a creditor, in which the individual is going to get a good or service with the expectation they have to pay that creditor back later. So that's kind of the gist of it.
The fee on there, right?
Yes, there is a fee.
Distro's upstairs
Okay,
on the first floor.
So next slide, please. With credit, there is going to be a credit report attached to that. And that's going to show the history of all the credit accounts that you've had in the past, how you've handled them, your payment history, as well as how you're currently handling credit. And next slide, please. Also, again, if you have any questions, please feel free to ask me during the presentation. I love questions. So with a credit report, there's going to be 3 different reporting agencies. There's Experian, Equifax, and TransUnion. It's important to note that all 3 of those different reporting agencies might have different scores across them. And that's because they sometimes will factor things differently or have different scoring models, as well as smaller financial institutions and collection agencies might only report to 1 or 2 of the credit bureaus. So it's very important to review all 3. And next, please. One way you can do that is going to annualcreditreport.com, and you can get sent a free copy of your credit report for you to review for accuracy, make sure there's nothing fraudulent on there, someone's not trying to steal your identity. With that, it's not going to have a credit score on it, but it will show all of your trade lines or your history of your credit accounts. Okay, and next slide, please. So a credit report is going to include your identifying information. It'll show your name, your address, your social security number, your year of birth. It'll show any credit accounts or history that you have, anything you've had in the past or you're currently handling, as well as any bankruptcies or collections. And then finally, it will have who has accessed your credit in the past. Those are called credit inquiries. And next slide, please.
Is a trade line just open, like a line of credit?
Yeah, so a trade line is going to be that credit account. We call them trade lines or credit accounts. So like a line of credit, a credit card, or even like a car loan, house loan. We call them trade lines. A credit report is not going to include your income on it or any assets that you do not have a loan currently on. So if you have a vehicle that you own without paying a car loan each month, it's not going to show that on your credit report. It also won't show any savings you have. And then typically it's not going to show bills like rent or utilities. I say typically because some rental companies do report to credit. They're pretty few and far between, but there are some out there that do. And then for utilities, there is this new thing called Experian Boost, which allows you to self-report your bills and utilities to your credit to try to boost up your credit score. And I'll get into that a little bit more later as well. Next slide, please. So a credit score is going to be a 3-digit number that is calculated using your credit report to determine how risky it is to lend to you, basically. So they look at what's on your credit report and come up with a number that's going to tell us how likely you are to pay someone back as agreed. The lower the credit score, the more risky they think they are to lend to you. The higher the credit score, typically, you're less of a risk to lend to. And next slide, please. I do really want to stress this, though, that a credit score is not always a financial health score. I have seen it where people have had a high credit score but carry a lot of debt and have no savings at all. On the flip side, I've had someone that has a lower credit score. They had an emergency savings, but they just didn't really have a lot of debt. It's not always going to be a determination on your financial health.
Am I right?
You're good.
Okay.
So there are 5 factors that go into calculating that credit score. The first factor, the biggest one, 35% of your score is made up by payment history. So how often you make your payments on time, every month. That's the best thing you can do for your credit score is making those payments on time. Next up, we have credit utilization and amounts owed. They're kind of hand in hand. We like to see loans decrease over time. We don't want to see them increase or stay stagnant, which often can happen with like student loans because of the interest on them. So I also mentioned credit utilization. Credit utilization takes all of the revolving accounts on your credit. And by revolving, I mean lines of credit, credit cards. It's going to take your limits on all of those lines and add them all together. and then divide it by how much you actually owe on those credit accounts. So for example, I have 2 credit cards that have a $5,000 limit on them each. I'm going to have a $10,000 limit total. Let's say I owe $3,000 on each of those. That's $6,000 together. I divide those two, and I'm going to get a percentage. In this case, it'd be 60%. So I'm using 60% of my total limits on my credit. That number can affect your credit score because the more you use of it, the lower your credit is going to go down because they think you're maxing out your trade lines. We like to see those credit accounts stay below 30% if you're going to use them. But I do want to highlight the best thing to do for your credit cards or credit lines is to pay them off every month if you're able to. That's going to be one of the best things you can do for your credit.
We have a question from the crowd. Would this be a good time to ask what are the pros and cons of a credit card?
Yeah.
Okay, that's the question.
So a credit card can have its pros. It can be an emergency backup for you. Let's say if you don't have an emergency savings and something comes up, like your car breaks or a house repair or something like that, that is going to be sitting there for you to be able to use. It allows you to use it and then pay it back over time. A lot of people get perks from credit cards. So some credit cards have points where you can earn certain rewards. So those are kind of the perks for it. It's also best when traveling. I like to always recommend a credit card when traveling a lot because it's much easier if someone steals your information for your card. It's much easier to get that resolved than with a traditional debit card.
Okay. And then one more. Why do you have or lose your credit score points after paying off a credit card?
You shouldn't lose your credit score points after paying off a credit card unless you close that credit card. If you pay off a credit card and then close out that credit card, it's going to say that you don't have as much limit anymore, and then you're also going to lose that account history, which factors into your credit. But if you pay off your credit card and just leave it open, it should boost your credit score. In fact, for every percentage you pay off in that credit utilization, your credit score should go up 1 point for every percentage that it goes down.
Okay, thank you.
And next slide, please. Next up, we have length of credit history. This could also be something that is impacted if you close out your credit card. Length of credit history is going to take your oldest account on your credit, your newest account on your credit, and take an average of it. So the longer that average, the better it is. It'll help your score. But if you're closing out a line of credit, your history with that is going to go away. Same with if you're opening new trade lines on your credit, that history will go down because the average is going to go down. That's oftentimes if you see that you get maybe a new auto loan and your credit goes down, that could be a factor into it. Does that make sense?
Sylvie, I have a question.
Yeah.
Can you, once you have a credit score established, can it go down to 0?
No. So typically the credit score of 0 is only going to be when you have no credit established at all. From there, the credit scores range from 300 to 850. So once you've established credit, you're always going to have a score. All right, next up, 10% of your credit score is factored by new credit. And you'll often hear this also as credit inquiries. Every time you go to a financial institution and get a loan or apply for a credit card, that institution will do what's called like a hard pull of your credit. And that's more of a deep dive into your credit report. And that's how they determine if they are going to lend to you or not. Those credit inquiries actually remain on your report for 2 years. So if you're going and applying for multiple different forms of credit, we'll be able to see that when we look at your credit report. And it could raise a red flag to that financial institution that you're going to multiple different places trying to get a loan. So they might ask you about it, and it also can impact your score. Then lastly, that last 10% is credit mix. We like to see when you can manage multiple different forms of credit. So a student loan, well, you don't always have to have a student loan, but an auto loan, a credit card, a line of credit, just different forms. We like to see that you can handle all of those instead of just having credit cards or just having loans that aren't secured by a property like an auto loan is. Does that make sense? All right, next slide. So those are all the five factors that go into your credit score. And next slide. As we said before, it is possible to have a 0 credit score if you've never had credit, but most of the time you're going to have a score within 300 to 850. The range of 300 to 579, that's going to be considered poor credit. And usually that means interest rates are going to be higher because you're more of a risk. Then we go fair, good, very good, and excellent is going to be 800 to 850. The U.S., it fluctuates every year, but typically they're in that good category. And the next slide. So we talked about what credit is, what a credit score is, credit report. Why is a credit score and credit report important? Why is credit important at all? Anyone want to throw out why it's important?
It's like you're gonna make all your major purchases.
Yeah.
It affects your insurance somehow.
Yeah, it can impact your insurance premiums.
Landlords, well, if you're renting,
Yeah.
require credit.
Sometimes job applications, unfortunately.
Yeah. You guys are hitting all the good points. If you want to go to the next slide. So first up, it can impact your ability to rent or purchase a home. I actually know this one firsthand. When I turned 18, I was enticed by all of those envelopes coming in the mail that I was pre-approved for credit cards. So I just applied for a bunch of credit cards because why not? And then I decided not to pay them back and just avoided them completely. I was like, out of sight, out of mind. I don't want to deal with it. Well, a couple of years later, when I wanted to move to Lansing, I already had a job, so I was commuting about an hour and a half. I tried to get an apartment, and everywhere I went, no one would approve me for an apartment because my credit score was very low. So I ended up actually having to move in with someone off Facebook Marketplace, but that is a story for another time. But because I decided to just not handle my credit responsibly, I was spending a lot on gas just to drive. I put myself in a situation because I needed a place to live. So that really was something I had to go through personally to know why credit is important. And hopefully you guys don't have to go through that after learning this. Your ability to get and keep some jobs. So employers will actually pull your credit and look at your credit when they are trying to determine if they want to offer you a job. Not all do, but some are able to, and they can actually deny you for employment if your credit is not good. And then next. And then one of the biggest ones is your ability to open a bank account. Most financial institutions will pull your credit and look at your credit before allowing you to be a customer or a member at their financial institution. They're looking for collections on there. They're looking to see if you ever brought a savings or checking account at another financial institution negative and never paid it back. If they see any of that, they could flat out deny you from being able to bank there. Access to loans and credit cards, that is also something that will be impacted. So if you need a loan or a credit card, you might not be able to get it because your credit is low. Or if you do, you're going to be paying more for it. And then with that, if you're not able to get a traditional loan or credit card, you might become dependent on payday lenders. Does anyone know what a payday lender is? Do you guys know what payday lenders are?
Yes.
Yeah.
Don't they charge you interest like every day?
Yeah, so they charge you a lot of interest. A payday lender, you can't get a traditional loan, so you go and they're going to lend you money based off your paycheck. Usually they expect you to pay it back by your next paycheck. Well, they're also going to charge you a lot of interest. I was helping one member once and their interest was about 300%, which is absolutely insane.
National average is 383.
Courtney said the national average is 383%
On the payday loans?
on the payday loans.
Well, that's interest
That's interest.
that includes fees
Yes,
because they charge a lot of fees in addition to the base interest rate.
right.
So when they're calculating that 300%, they're really calculating in not only the interest, the base interest rate, but the fees as you're rolling over and doing other things on the payday loan.
Right.
It's
So-
about $15 per $100 borrowed in Michigan. Goes down with each one, but technically it's not interest, it's just that fee that has been paid in 2 weeks. So if
Oh,
you're
wow.
borrowing $300, you're paying about $45 to borrow that. But statistics show that 80% of people borrow right after that, continue, and that's you're paying
Yeah, because
$45 every 2 weeks to what 100.
because once that 2 weeks comes around and you have to pay it, you're not going to have any money from that paycheck. So you're going to turn around and do another one. And it's going to put you into this vicious cycle of always owing payday lenders and never having money. So that is something that is.
Two things from the crowd. One is it better to have a cash advance or use your credit card than have a payday loan?
Yes, 100%. It is better to use your credit card than have a payday loan. Because while credit cards do charge you interest if you carry a balance on them, if you are able to pay that balance off or what you've spent on it off before the statement date or the due date, then you're not charged interest at all. So you could potentially use your credit card to purchase something and pay it off before the due date and not have to be charged any extra fees. Whereas with payday lenders, you're going to be charged fees, a lot of fees and interest.
Well, I was specifically asking about a cash advance on a credit card.
So a cash advance on a credit card is going to charge you a percentage. Usually it is higher than a regular interest rate, but I still think that is better than a payday lender because it's going to be it's going to be a monthly charge if you can't pay it off fast, but it's still going to be less than getting in that cycle of payday lenders and the fees and interest. So
And you can build positive payment history.
yes, you can build positive payment history.
Yeah, payday lenders in Michigan do not report to credit bureaus.
Right.
Okay. And then the other one is more of a sentiment comment. Why do people get charged more when they have a bad credit score, which usually is an indicator that they're poor? It seems unethical to just be beating them down the entire time.
Yeah, I could see that. The reason why people get charged more when they have a lower credit score is because financial institutions and credit unions, they are a business and they are lending to you. And when we see that you have a lower credit score, it usually means that you are more risky because you'll have collections like maybe you haven't paid a financial institution back before. And so if you haven't paid them back, what are the chances you're going to pay us back? So we have to mitigate that risk. They charge more interest for you. And hopefully you can use those practices to improve on your credit and eventually not have as much interest rate, but that is really what it has.
Yeah, if I could add something to that, being poor is not indicative of having a poor credit score. You can be poor and have a good credit score. But on the other side of that, there are a higher percentage of people that are poor that have poor credit scores because they have not learned about the credit score and how to effectively manage it. Because it doesn't cost you any money to effectively manage a credit score. But if you're not knowledgeable about what goes into doing that, you can very easily fall into having a poor credit score. But knowledge is power, And if you know what you're doing and you understand credit scores and how to manage it effectively, you can be poor and have a very high credit score.
And vice versa.
Yeah, and vice
You can be
versa.
wealthy and have a terrible
Right.
credit score.
I've seen people that make a lot of money each month and their credit score is very low because they just do not manage it correctly. They're overextending, they're living outside of their means. So it can be, yeah, it can be different.
And then I'll throw one more thing on.
Yeah.
A lot of these can be poverty traps, like for example, payday loans and all of that. I'm trying to lop you guys pitch to talk about either your certification that you had with NSF, right? And
The bank on.
Bank on, and the your alternative to a payday loan.
Yeah.
Is that going to come up at all?
Yeah, we can talk about that. So a lot of financial institutions have been developing alternatives to payday loans, and we actually have one that's pretty great. You can, once you establish a relationship with us, you can do a payday loan. They don't look at your credit, but we do report to your credit, like your payment history. So that's something that's different than traditional payday lenders. And we give you certain terms to pay it back. So it's not going to be due by your next paycheck. You have, depending on how much you borrow, it'll assess a term like 3, 6, 12 months, depending on how much you borrow, up to $2,000, I believe ours is. The interest rate is a little higher. It is going to be 24.99%, which is higher, but it is a lot lower than 383%, which you would get at a traditional payday lender. And because we give you longer to pay it back, your monthly payments on that will be lower. And it could improve your credit score because if you pay it on time every month, it's going to show as positive payment history and boost your score up. Because, again, that's the biggest factor that goes into your credit score. Did that kind of answer that one for you?
Yep.
And then we do have a checking account called Empower Me Checking, and it is bank on certified. However, we try to use that for, I mentioned earlier about people that have brought accounts negative at other financial institutions and never paid them back. Typically, they can't get bank accounts. At Astera, we allow you to get a bank account. We allow you to get a checking. It's going to be a little bit more restricted because, again, we have to mitigate that risk somehow. But you're able to get that checking account. It's going to save you money because you don't have to go to check cashing places where typically you have to pay to cash your check, or even direct deposit cards have fees on them. So that won't be something you have to pay every month. You're able to have a debit card. It's going to have a smaller limit. And then it does not have NSF fees, correct?
No
Non-sufficient
courtesy pay.
funds.
No
No courtesy pay, though. Courtesy pay is when you're allowed to bring your account negative, and then it's going to charge you a $30 fee. That account, we don't allow it because of the past on your credit. But it is a really great way to start building a relationship with our financial institution. And once you're in it for about 9 to 12 months, then we can move you to a regular checking account that has all those great features we have. So something we're doing. Any other questions?
There is one more.
Yeah.
Not taking into account emergencies, what are good reasons, business or personal, to utilize credit on as opposed to saving or spending what you have?
So I would say the only time you really want to use credit is if you're getting something in return. So that's going to be like the rewards cards. If you're able to get points on things you are spending, go ahead and spend on that card, but pay it off every month. So don't spend more than you actually have in your account. I know a lot of people that are able to manage them correctly use their credit card more than their debit card because they'll earn points and rewards, but they pay it off by the due date every month. So they're not earning interest and they're not spending more than they can afford.
If I could add something to that, 60% of the U.S. population does not have $400 in emergency savings. So with credit, what happens and why the need is there to have credit is a lot of people can't save, don't save. They've not been able to establish those habits because of life events, income issues, whatever it is. So what happens with credit is you need to be able to purchase something that is beyond your ability to afford with cash, a car, house, those type of things. Typically, you have to have credit in order to be able to have those things.
Mhm.
So building up and having a good credit report, building up your credit over time, ultimately with the thought that you want to have a nice car, you want to be able to buy a home, is very important, because if you're not able to build your credit, you have zero credit, or you don't have a good credit score, it makes it more difficult to buy those larger purchases.
Okay.
And I'd say not even the large purchases, but even the moderate ones, like a new
Right.
set of tires on a car to get you to work.
Yeah.
Yeah.
If you go with some of the in-house financing that some of those places have, they may be 100% interest because it's financed through out-of-state companies, and you're paying for $800, you're paying $1,200 for those tires. But you need tires to get to work to be able to pay the bills. So
Right.
having a relationship with a credit union or a bank where you can go, hey, I will pay $850 rather than $800 for that credit is better than the $1,200 option.
Yeah. And definitely financial institutions usually have lower rates, credit unions specifically, just than if you go to like Discount Tire and get their credit card. Their interest rate on their credit card is probably going to be a lot higher than going to a credit union and getting their credit card.
I'd like to just add to that real quick. So a lot of times people are stuck with the 0% for 6 months. What they don't typically read is the fine print, or if you don't pay off the full amount in that 6 months, they're going to back charge you interest to the original start date. And then that's going to get added on moving forward. So that's usually not discussed or talked about, but that's a trap that a lot of people get sucked into.
Yes. All right. Any other questions?
No, we're good for right now.
All right. So next slide, please. We kind of talked about it earlier, but car insurance rates and cell phone plans can be affected by your credit score as well. You could potentially be paying more in car insurance just because you have a lower credit score. Next. And then we kind of touched on this as well, how much you will pay to access credit. If you go to the next slide, I kind of have a little example here. So we have a car loan for 60 months for $20,000. Someone that has a 500 to 589 credit score, their interest rate is going to be 16.05%. I do want to preface this that these are just example rates. These are not the rates right now. But they'll be paying that much in interest, whereas someone with a 720 to an 850 credit score will pay 3.73% for the same exact auto. Same exact auto loan, same exact term. The first thing that's going to impact is their monthly payment. Someone in that lower credit tier, they'll pay $487 a month, whereas someone in that higher credit tier will pay $366 a month. That right there is a $100 difference. But I think the biggest impact, if you want to go to the next slide, is going to be the total interest paid over that 5-year term. Someone in that lower credit tier will pay $9,213 just in interest on that loan. Whereas someone in that higher credit tier will pay $1,952. That is a $7,000 difference on the same exact car, same exact term. What are your guys' initial thoughts on hearing that?
It costs a lot to have better credit.
Yeah.
It's expensive to be poor or have a poor credit score.
It can really cost you to have that lower credit, and that is, like we said earlier, because of the risk that the financial institution is taking on you. And I understand people need to get vehicles, they need to get to their jobs, they need to have these things. So a lot of places, I know we do, if you start with us and you have that lower credit score and you're getting that higher interest rate, if you work on your credit and you're able to boost it over time, we can help you out. We can do a modification to change your interest rate once your credit has boosted up. So that's something that we can do. I know a lot of places will, some places won't, but it does help out over time because if we can change your interest rate after you have improved your credit, you're not going to be paying as much interest. All right, next slide. So now let's talk about how you build or rebuild credit. So I'm going to start with building credit as if you have not ever had credit before. But these practices can translate into rebuilding credit as well. Next slide, please. And go ahead. First up, we have a secured credit card. A secured credit card functions very similar to a regular credit card. The only difference is you have to put money down to be able to get that credit card. So you have to have a deposit. For example, I give the financial institution $500. That's going to be my limit on that credit card, and that's just going to stay held by the financial institution. I'll use the credit card the same exact way I would any credit card with that $500 limit, hopefully paying it off every month. And the reason why financial institutions will do that is because that takes away the risk for them. You're essentially using your own money to make purchases. You make payment every month. It's going to build credit history, build a relationship with that financial institution, and show that you're able to manage a credit card responsibly. So that's how it's going to boost up your credit. Very similar to that, next slide, we have a credit builder loan. There are a lot of credit builder loans out there on the internet that market themselves as credit builder loans, but once you get into it, they're actually payday loans. And we see a lot of those, and they charge a lot of interest, and it, while it does report to your credit, it's still, you're paying a lot over the life of it. So I'm going to speak to our credit builder loan at Astera. You will come in and sit down with one of our member service representatives, and we'll determine a loan amount and a term for you, meaning how much the total loan is going to be and how long we're going to do it for. I typically recommend for any credit builder loan, you want to do at least 1 year because that is going to help you the most with your history of payments. So let's say I'm going to do $1,000 for 12 months. You don't get the money up front like a traditional loan. What happens is that $1,000 gets placed on hold in your account. You make your monthly payments every single month. At the end of that year, that $1,000 after you pay it off gets placed into your account. Some benefits of that is, again, payment history, building a relationship with a financial institution, and you can potentially use that $1,000 that you've paid into for the last year as an emergency savings fund that can sit there and help you build it. Next up, we have Experian Boost, which I touched on a little bit earlier, and that's when you self-report your bills and utilities to your credit. So like your BWL, your consumers. I've even seen Netflix reported to credit before. While it's great to boost your credit, I do want to highlight that financial institutions will look at that differently than a traditional credit building product. If that's the only thing reporting to your credit or your self-reported utilities, that doesn't show us how you can manage a loan or a credit card. So they're less likely to loan to you without like a cosigner or someone. Next up, becoming an authorized user on a credit card, and I want to say this with caution. An authorized user on a credit card is when you have someone that is the owner of the credit card and they're giving you basically permission to use that credit card and be on that. It's going to report to your credit that you're able to use it. However, if that original person is not managing the credit card responsibly, it can negatively impact you. So if they're maxing out the credit card, if they're not making their payments on time, it can actually hurt your credit score. So that's why we say with caution. It can be a great tool if it is with someone that is managing things properly, and it'll help boost up your credit score.
So if I'm an authorized user, do I automatically become like their line of credit, become mine type deal? Like if they got a 5K credit card and it's in good standing, do I automatically get an extra good 5K credit on my portfolio type shit?
Yeah, so it'll show as a $5,000 trade line on your credit. It will be coded that you are only the authorized user on it. so you don't own the credit card.
Does that affect the scoring?
It doesn't affect the scoring, but it will affect how maybe a financial institution might look at it. Because with the authorized user, you're actually not, I think, correct me if I'm wrong, you're not legally required to pay that back. The person that is the owner of the card is legally required to pay it back.
So if you sizing somebody up and you see they got a gang of bad credit, but then they was able to have some family or some friends hook them up with a unauthorized user, you basically just size them up still like you irresponsible. It don't really hold much value, right?
Right. It can hold some value, but if we see that everything else on your credit is not being managed right, but you're an authorized user and someone that is managing it right,
And that's the highlight report.
right, we would still factor that in with risk.
Can I give an example?
Of course.
So if you are a parent, and let's say I have a credit card that I opened in 2020, just use that as an example, and I have a child in 2020. And when they turn 20 years old, so in 2040, I add them as an authorized user, and this is their very first trade line. It's going to show that they opened this credit card in 2020 when they were born. That's going to reflect on their credit score. So they could have one trade line and make their credit score approximately 780 points, which is excellent credit.
Mhm.
But if you're looking at it as a financial institution, does that prove that that child deserves a 780 credit score? No, because that's not their credit card. It's just a trick that you can use to manipulate the credit score. So that's why we say use caution, because if I had that credit card maxed out, the child could easily start with a 580 credit score as opposed to a 780 credit score because I'm not using that credit card well. But that's the only trade line that's reflecting on that. But then you need to use caution from the other side, is that I also need to trust the child, because if they go and max out that credit card, they have zero liability. Yeah, they have zero liability to pay that back. I have all the liability to pay that back. So you need to use caution with who you put as an authorized user, as well as use caution of being an authorized user.
When I looked at my credit report the first time, I realized my credit history was about 6 years longer than my actual history for that same reason. So.
Yeah.
Good.
Yep. So we talked about building credit, now rebuilding credit. So if you're starting from a place of a lower credit score and you need to rebuild credit, here are a couple things you can do. So first, we want to pay off any outstanding past due balances. You want to prioritize the ones that are still open on your credit, meaning they haven't been sent to a collection agency or what's called a charge-off. A charge-off is when the creditor has decided they're not getting their money from you. They're not getting your monthly payment. So they're going to completely close it out, and then your full balance is due at that time. So that's what a charge-off is. You want to prioritize anything that's still open. So maybe that's 30 or 60 days late that you haven't made your monthly payment on. Because once it's sent to collections or charged off, it's much harder to deal with and it impacts your score more. Once you've prioritized those open past due accounts, then you start with the collections or charge-offs. I always recommend starting with the smallest one first. As humans, we like to see progress. We like to feel like we're actually taking steps to help your credit. So start with the smallest one to pay that off and then move on to the next smallest and from there, because you're going to be able to see that progress more and keep going instead of getting discouraged. Okay.
That's the snowball effect type of
Kind of. Yeah, if you have the ability to do the snowball effect where once you pay off that one collection, you can apply what you've been paying to it to the next one, you're going to take everything off faster. Next up, those credit building products I just talked about, those can also help to rebuild your credit, because I talked about it quite a bit about establish a relationship with a financial institution. That goes a long way with us. We see that maybe you have always paid your Astera credit union loans back, but you have a collection to Capital One on there. We're going to weigh that a little bit differently. Yes, we don't like to see that you haven't paid a creditor back, but if you've always made on-time perfect payments with us, that's a different story. So a relationship goes a long way with credit unions. All right, let's get into credit myths. Before I go, I have about 5 of them on there, but I want to hear from anyone online, in person. What are some things you've heard on the internet? Maybe it's Facebook, TikTok, whatever, about credit, and you're not sure if it's true or false. I want to get into those. Anyone? All right. My friends in the back too, if you guys have any on the top of your head.
Can't think.
All right.
Paying your bills goes on your credit.
Paying your bills go on your credit. So not unless you self-report them with Experian Boost. However, if you do not pay your bills, it can be sent to a collection agency, and then it will be reported on your credit as a collection. And that will negatively impact you.
So I have one.
Yeah.
One of the best ways to help your credit score is to write a handwritten letter, made it as long as possible, and note every single item on your credit report and request proof for the debt that it's yours. Request the original agreement with your signature and request it to be sent with you within 30 days.
I've never actually heard that one.
If you do that, you can start to fight. Basically, write this out to the people that are on your credit report. If they don't respond with you, it'll get taken.
So
Yeah.
with that,
So
are
it's
you
a
basically
dispute.
like just trying to bank on their laziness though? Because it is your
Yeah.
in a sense, right? You just hoping they don't respond or get the time back, basically. You just
If it
hoping to do
works.
and just looking at a percentage. All right, maybe hopefully they don't hit us back.
You can, I know, dispute bad marks on your credit report,
Mhm.
and the credit bureau has to set those aside while they're under dispute, which will give you an instant boost, but not a permanent one. If you act, if you have a car loan that you didn't pay off, that'll go back.
And I want to kind of piggyback off that by saying trade lines usually stay on your credit anywhere from 7 to 10 years. Collection is about 7 years. If you dispute something and it's been on there for 3 or 4 or 5 years, if you dispute it, they take it off. When they put it back on, that 7 years starts over again. So it'll be on there for another 7 years, and it will also be newer, so it'll impact your score even more. Typically, after 2 years, collections do not impact your score as much. So your older collections are not impacting it as much as something that's going to be newly reported to your credit. Now, you still want to pay those because it's something that you owe, but if you are disputing things just because you want to try and get it taken care of, it could potentially hurt your credit even more.
Okay.
But if it's something you actually do not owe and it's being there, go ahead and dispute it because we don't want that on there.
The person who wrote it clarified it goes to the credit bureau, not the creditor. And then another person online said that they tried it, but I don't know their result yet. I guess.
One other myth, and I heard this a couple times from a lobbyist for the payday lending industry, where he said credit is the only thing you earn in life, or it's the one thing you earn. And I would put that as a myth as well. Credit, having a low credit score doesn't mean you're a bad person or you are a irresponsible person. There are a lot of things that go into it. So
Yeah, there's a lot of things that go into credit, and it could be something that's happening in your life, something like you lost your job or something like that, and you're not able to make payments. That doesn't mean you're a bad person. If your credit's low, it does not mean you're a bad person at all. So that's why we try to say it's not really a financial health score. There's so many factors that go into your finances.
I don't want to tell you their answer.
Did it work?
Yes.
Okay.
So it did work for them. I don't know if it was temporary or not.
I will say that when I was 19, I tried to dispute something on my credit report, and it had already been on there for about 3 years. And when I did it, it refreshed it and did it so it was gonna stay on there for another 7 years. So it went off and I was like, oh, that's so exciting. It's not there anymore. And then a month later, it popped back up. My credit score dropped. And then I have 7 more years of it being on there until it's removed or I pay it off. So it can work, but it also can't work.
Right.
So
So
there's
it
a
can,
risk.
can.
There's a risk for sure.
At the end of the day,
You just
it's
play
your debt.
percentages, basically.
Yeah.
And there will be a note. So there will be a note on the bottom of it. If you try and then it doesn't work, that will say disputed by consumer, lender disagrees.
Okay. We're good.
Any other ones that you guys can think of?
Put half of your limit on your credit card and only make minimum payments.
Right. If you want to go to the next slide. So one myth is you must carry a credit card balance from month to month in order to build credit. That is completely false. You do not have to carry a balance on your credit cards to help build your credit. Just having that open credit card limit there with nothing on it is actually going to help your credit a lot. Again, we want to keep it under 30% credit utilization. So if you must carry a balance on it, try and keep it under 30% of your limit. Anything over that, it will start to impact your credit a little bit more. Next. All credit scores are the same. What I see on Credit Karma is going to be the exact same thing that my credit union or bank will see when I go to get a loan. We see this one a lot. People think what they see on Credit Karma is going to be what we see, and that's not true. The reason behind that is there's 2 different kind of credit pulls when we look at credit. There's a soft pull and a hard pull. That hard pull is going to be the deep dive into your credit that financial institutions use. And that will also have a credit inquiry on your credit. So that one will damage your credit just a couple points. It's usually like 2 or 3 points when you do it. But that's just a deeper dive into it. Whereas Credit Karma is more of a soft pull. It's a general overview. It's helpful for you to review and look at, but it's not always going to be the same when you pull them.
I'd also say I like the analogy. It's like using the metric system versus like what we use here. Like 12 centimeters is different than 12 inches.
Yeah. That's a good analogy. Next. Opening a new credit card every time I get an offer is a good thing for my credit score because you need lots of credit cards to build credit. So while opening a new credit card will give you more limit on that credit utilization, there's a couple things that can impact negatively. So it's going to impact your average age of your credit accounts on your credit. And then it's also going to give you a new hard inquiry. So those are some negative impacts. A potential for that as well is if you have a lot of credit cards and you're using them and putting balances on them, it can get confusing to manage all the different due dates, all the different amounts, and you could potentially miss a payment or overspend on it. So it's really best to only open credit when you need it. Closing your credit card when I paid it off will improve my credit score. We kind of talked about that earlier, that closing it, if you are able to manage it correctly and you aren't overspending on that credit card, leaving it open is going to be the best option because of your account history on it and that utilization percentage. But I do like to stress, if it's something where you're not able to manage it correctly, if you're overspending and it's just going to be too dangerous for it to sit there, go ahead and close it out because in the long run, it's going to help you.
What about like annual fees? How do those come into play?
So annual fees, there's a lot of credit cards that can give you benefits without annual fees. Usually higher reward credit cards are going to have higher annual fees because you're kind of paying for those rewards. So those get added to your balance on your credit card every year. It's kind of.
So you want to look for a financial institution or credit union that doesn't have an annual fee with their card.
Yeah.
I mean, you really don't need it unless you are looking to get rewards and getting a lot back in terms of the rewards. Our cards do not have annual fees associated with them.
And typically, when it has an annual fee, it's a reward card, and reward cards also have higher interest rates on them. So if you're going to carry a balance on it, you're essentially paying for those rewards in one way or another. But we have 2 credit cards. One's called our low rate and one's our rewards credit card, and neither of them have a minimum or a annual fee on them.
But the interest rate is about like a 4% difference.
Right, because of the rewards.
So the rewards card has a higher interest rate.
Yeah. So shop around, figure out what credit cards are going to help you in the long run. Don't just take any ones that they send in the mail, or I know Credit Karma will sometimes be like, you're pre-approved for this credit card. And that sounds great, but look into the small print, figure out what all comes with that credit card.
Yeah, I didn't know that 0 to 6 month or 0% for 6 month trick there.
A lot of times credit cards will also get you with a 0% balance transfer. Like if you transfer a balance from another credit card and you have 0% for this amount of time, what they don't tell you is you have to pay like 3 or 5% of that balance to transfer it over. Most credit cards have one. I know we don't actually charge a percentage to balance transfer to our credit cards. So finding different ways to help. Next.
That was
Checking my credit report will hurt my credit score. I kind of touched on this as well. That soft pull you do with like Credit Karma, Credit Rise, Credit Session, all of those, that will not hurt your credit score at all. Looking at those, monitoring them, I actually like them because like Credit Karma will send you an alert whenever something changes on your credit report. If your credit gets pulled or something, it helps with you being able to monitor it, make sure no fraud is happening on your credit report, make sure your identity is not being stolen, stuff like that. So they can be very helpful tools, and I encourage you to monitor your credit, look at it, and use the annualcreditreport.com to get the full report every year.
And LifeSense has a way to connect you to that easily too, right?
Yeah, I think
Got the
so.
link.
Yeah, it's a link.
Okay.
And next. All right, so we talked about what credit is, why it's important, what factors into it. We busted some of those credit myths or learned about some new ones. Let's talk about some healthy credit habits to practice. Next. First up, make every payment on time every month. I'm going to stress this, and if that's one thing you walk away with today is make your payments on time every month, because it is the largest factor that goes into your credit score, and it's going to be the best way to help your credit.
Can I add to that?
Yes.
If you cannot make your payment, communicate with your lenders. You can let them know before you're late that something's happening, and most lenders will work with you.
Should we do that in a long handwritten letter?
No, you can just call them.
Okay.
Yeah.
It's not necessary.
Next. Keep those credit card balances low. Do you guys remember that percentage I said? What
30.
percentage?
30.
30, under 30%. Best practice is to pay them off every month, but we know that's not always feasible, so keep it under 30%. You'll be good. For every 1% you free up, your credit score should go up 1 point. Next. Don't apply for new credit unless you need it. Be strategic with it. If you're not needing new credit cards, if it's not going to benefit you in any way, don't apply for it. And then kind of what Courtney was just saying, don't ignore your bills. Even if you don't think you should owe them, call. Communicate with financial institutions, collection agencies. Communication is pretty key. Like she said, if you can't make your payment that month, call us. We can figure out different ways to help you. Maybe it's doing a skip payment for that month because there's some hardship going on, or we can set up an arrangement with you that's going to benefit you, because once it gets on your credit, it is so much harder to get off your credit. So communicate with medical bills. If you get a medical bill in the mail, a lot of them will let you set up small payment arrangements instead of just letting it go to your credit. It could be as little as $5 to $10 a month.
Isn't that a potential myth that medical bills don't affect your credit, or do they affect your credit?
They do affect your credit. They can report to your credit. But we don't look at them the same as, like if you have a medical collection, we don't look at them as the same as like a credit card or a loan collection on there,
Okay.
because we understand that a lot of people have medical bills. Do you want to add something, Courtney?
So it was the beginning of last year that they actually changed the scoring model so that they aren't weighted the same as other collections now on your credit report.
Mhm.
And I also wanted to add, when it comes to getting a medical bill, there's a lot of times where I've heard, well, my insurance should have paid for that. Just because you think your insurance should have covered a cost, if you're getting a bill in the mail, the place that you got your medical attention from thinks differently.
Right.
So you need to follow up on that bill. Ignoring it is only going to damage your score.
Yes. Yeah. A lot of collection agencies, you can, once they're on your credit, you can call and set up payment arrangements with. A lot of times they'll allow you to settle the debt for less. That's not always the best because it will say right on your credit report that you've settled for less. Also, something I found out clearing up all my credit cards when I let them go to collections is if they write off more than $600 a year, you actually get something in the mail for your taxes, and you have to report that to your taxes as earned income. So that's something to keep in mind. But yeah, communication is key with all of that. Next.
May I say something to
Yeah.
the crowd real quick? I just put a comment in. If you comment within the next 5 slides, we'll be finished at that point. You will be in the drawing for $50.
Oh, wow.
And if you're here and all that, then you are anyway.
Nice. All right.
Oops. Sorry.
No, you're fine. I touched on it, but review your credit report annually. It's really helpful to review it to make sure that it's accurate, make sure no fraud, and then make every payment on time every month. I've had to put it twice because it's so important. And all right, so I want to touch a little bit on Astera Credit Union because that's what where we're from. We're a Lansing-based nonprofit financial institution, and we focus on improving the financial health and well-being in the communities we serve. So coming out to places like the Pledge and educating and making sure people are aware of what credit is, how it's important, how it impacts your life. We also do this by our Empower Me program. I don't know if some of you have witnessed Martin's talk on our Empower Me program, but it is our financial wellness program where a coach will sit down with you and they will walk you through setting up a budget, setting up a spending plan, going through your credit, figuring out the different ways where we can help you improve your credit, take care of things. Lots of financial education will come with that. It is outcomes based because we like to see an improvement throughout it. We want to see your credit improve. We want to see that you have an emergency savings by the end. And then hopefully by the end of it, you'll be able to be approved for something like an auto loan, or we've had people that have started it and they weren't able to rent a place, but they put in the work and they really buckled down. And by the end of it, we were able to give them a mortgage. So it's very impactful. Our coaches are very passionate about what we do. We love to help people. A lot of us have been through it ourselves, so we can really connect with you in that way. If you are interested about it, I'm going to have my information on the next slide. You can reach out to me. I'd love to talk to you a little bit more and see if we can help you. Next up.
Oops. And the last.
Yep, last slide. So you can learn more about at our asteracu.com. That's our website. If you wanted to call in and talk to someone, our virtual branch phone number is right there. And then I've actually put my phone number. That is my direct line. You'll get me directly if you call that, or our outreach email. That's going to go to our coaches, and someone will reach out to you. So yeah.
All right.
What questions do we have? Any questions?
Yeah, all right. It might not, yeah, I guess it is money because it is credit. When it comes to like paying it off, right? We was talking about like knocking out, I got $500 cards and I got, a few $1,000 cards. And it's like, all right, do you just go attack the smallest card, obviously, because it will be the easiest, or do you go for like the highest interest card or the one that's hitting you with the, you know what I mean? That's kind of what I'm torn between. Because it seems like you ain't making no progress on the $2,000 card with high interest.
Right.
It's easier to knock out a $400 card. But more realistically, I mean, that high interest will kill you. You know what I'm saying?
Right.
So which is it ain't no right or wrong, but what would you
Yeah.
suggest as the
I
preferred approach?
I would always suggest to knock out the highest interest one first, but if you're feeling discouraged that you're not getting anywhere, go ahead and knock out the smallest ones and then apply what you're putting to the smallest ones to that larger one. So whatever you're paying on that smaller one, once it gets paid off, take that exact same payment because it's out of it, something that you were already allocating to something anyway, put it towards the largest one, and you're gonna see that be paid off a little bit more.
All right, and then on the second part two type thing. So if I'm using like a high percentage right now and I'm just working on paying it, I got an opportunity coming soon where in some programs you get grants, some give you loans. I kind of do want it and want to do stuff with it, but is it a situation where taking out more will hurt it, or even if I do take it, will that like lower the utilization rate and just not use it and still work on paying it off? If that makes sense.
So if you can get a loan to pay off those balances, it will probably typically be a lower interest rate. I would double check to make sure that it's a lower interest rate, but that could help you because you will pay off all those cards. Your utilization will go up, but you'll just have like a loan.
I get yeah, not to pay them off, but like because I'm in one program where they offer like up to $5,000 loan, right?
Mhm.
So it's like, do you deny it or do I just keep it and sit it there and still work on my credit to have a good standing available 5,000, and that'll lower the usage rate while I'm still working on my current? Or do you just leave it alone and try to knock out the current? You know what I'm saying?
Is it a loan or a credit card?
It's a loan.
So,
Oh, so shit, right?
so you're paying interest, but it's just sitting
Yeah.
there.
That's not even the same. But yeah,
But if you can get a loan at a lower interest rate and use it to pay off the credit
yeah,
card.
I mean that's kind of what I'm thinking about doing
That would be the
also,
best.
right, to make
Especially if
yeah.
that loan's gonna have a lower interest than what you're paying on your credit card.
It can help you like make it more manageable too. So if you're paying higher on like, if you have separate credit
Couple
cards and there's a
credit
bunch
cards,
of different
pay out
payments.
the Capital One and then knock them out with the loan from the bank.
And if they all get paid off, then your credit score is gonna go up because your utilization is gonna go down.
Do those loans show up on your credit too?
Yes,
All right.
they do.
They're not credit. Yeah, I got you.
Yeah, they still show up and they'll be on there, and it'll help with like payment history and stuff like that.
All right, that's all I have.
Any other questions?
No,
All right.
I think everything you covered.
Well, if you guys do have any questions, please reach out to me. And I really thank you guys for having me today.
All right. I think it was great. We had a lot of feedback. We've averaged about 17 people online.
Oh, wow.
the entire time. So that was good. And I've shuffled this 100 times.
Ron.
Ron. Lucky Ron. So Ron Ferguson is the winner of
Congratulations, Ron.
the $50. Ron Ferg.
Going towards the credit card bill.
So that's it, everyone. Next week, the last Saturday of the month, 10 to 12. And 10 to 12. Sorry, Julie, I changed it in
That's okay.
January. And thank you all for joining us. You can watch this again on YouTube or on Facebook for another 30 days. Love y'all. See ya.